Over the past decade, countless Bangladeshi investors have suffered heavy losses because of uncontrolled margin loans. When markets fell, their losses multiplied, and many saw their life savings get wiped out. Brokerage houses, merchant banks suffered as well, often due to weak internal controls, delayed margin calls, and poor risk management practices. But this cycle of damage, hopefully, is on its way to end now. The Bangladesh Securities and Exchange Commission has proposed the new Margin Rules 2025. These rules focus on one mission: protect investors and enforce strong governance. This is Tahmina Jahan, an analyst at Lion City Advisory. To understand the reform, we must first understand the product. A margin loan is a loan provided by a broker or a merchant bank that allows an investor to buy shares by combining their own money with borrowed money. The rules impose a strict maximum 1:1 loan to equity ratio. This means if an investor has 1 lakh taka of their own money, they can borrow at most 1 lakh taka, not 5 lakh, not 10 lakh, ensuring investors cannot borrow more than their own capital. And if the market price to earnings ratio rises above 20, the system automatically lightens to 1:0.5, a built-in market stabilizer to prevent overheating. Portfolio-based tiers further refine risk. 5 to 10 lakh portfolios capped at 1:0.5 ratio, 10 lakh and above eligible for 1:1 unless the price to earnings ratio restriction applies. This reduces leverage risk for new investors and encourages portfolio maturity. Life insurance shares get the strictest limit of all, only 1:0.25 ratio. If someone has 1 lakh taka equity, they can borrow only 25,000 taka to buy life insurance stocks. And if a life insurance company lacks an updated actuarial valuation, no margin financing is allowed at all. This protects investors from sectors with historically unstable financial disclosure. Risk management is now non-negotiable. Investors must maintain 75% maintenance margin, and if equity falls to 50%, financiers must execute immediate forced sale. Critically, financiers are liable if they fail to act on time, a major shift that enforces discipline across the industry. Refinancing is restricted to realized gains only, eliminating artificial loan expansion during market upswings. Exposure limits also protect financiers. Maximum 15% of net worth or 10 crore taka per client. Maximum 15% exposure to any single security. These reduce concentration risk and prevent institutional vulnerability. Eligible securities are now filtered for quality. Only A category and specific B category shares on the main board qualify. No financing is allowed for stocks with price to earnings ratio above 30, free float below 50 crore taka, going concern warnings, or dormant operations. This directs margin financing toward fundamentally sound companies. Taken together, these rules transform the market. Investors benefit from greater safety, brokers gain clearer boundaries, systematic risk is contained, and the market becomes more stable, transparent, and resilient. Lion City empowers high net worth individuals and corporates through SMA or separately managed wealth account-based wealth management backed by strong compliance and risk discipline. We decode regulatory frameworks, build compliance-ready policies, and guide operational restructuring with structured documentation and ratio-based decision models. Our goal is to make every client not only compliant but strategically stronger and resilient. That's all from us for today. See you in the next video.